Welcome to the very first episode of Yahoo Finance Uncut. And I'm sitting here with Mark Yusko, CEO and CIO of Morgan Creek Capital Management. Very excited to have you here today, Mark, for our premiere episode. As the name implies, Uncut, there's not going to be a lot of frills here, but we do have some presentation materials and, of course, a lot of deep conversation. And Mark, we're going to talk about crypto here. This is going to be the focus of the day, but I want to get your big picture overview of what you're seeing in the markets right now, because this has been a frustrating year for a lot of investors. There's been a lot of pain trade, a lot of rotation. We got a lot of volatility, a land war in Europe, just to kind of throw a monkey in the wrench there. Plus, we got the Fed hiking, 50, 75 basis points now? What do you make of all this, Mark?
Yeah, Jared. Well, one, really honored to be numero uno on the show and for the first episode, really excited for what you're doing here. I love the idea of uncut, right? Let's just talk and get everything out there. And to your point, this has been a crazy year. And I don't use that word lightly. I'm prone to hyperbole, but I don't think it's hyperbole to say these are trying times and crazy markets. Everything was down at the beginning of the year, other than commodities. But stocks were down, bonds were down, crypto was down. Everything was getting really beat up. And part of that was related to fear of the Fed taking the punch bowl away and central banks around the world tightening liquidity. Although that hasn't exactly been the case. There have been interesting things going on in Japan, where they're doing yield curve control and buying up all the bonds they can find. Yet that's done nothing to slow the decline of the yen. And so things that you would think would normally occur have not happened this year. And one of the things, other than today, it's interesting that we're having this conversation today, there has been, for the first time, a little bit of flight to safety, where stocks headed down and bonds, surprisingly, headed up, prices up, yields down. So I think that has been really the conundrum for investors, is if the Fed was going to tighten, despite all the information that would say this is exactly the wrong time to tighten, from slowing GDP growth to earnings rolling over to stock prices falling, today may give us a glimmer into what I refer to as the Powell pivot. I really don't think the Fed or anybody else around the world is going to go through with the threats of really cutting liquidity and raising rates as high as they think.
Yeah, it seems to be a little bit overblown, but nevertheless, I have a chart of the 10-year Treasury yield. Hopefully we can put that up here. This goes all the way back to early 1960. And Mark, I know you know this chart probably like the back of your hand. We have seen a bull market in bonds over the last 30, 40 years. Yep. That means that yields are depressed. However, guess what? Is it over? And we're seeing the beginnings of a new paradigm here. I mean, just look at this huge this huge trend to the upside that we've seen here. That's concurrent with the market repricing all this Fed risk, repricing all the inflation risk. Do you think we are at this turning point, and what does that mean for investors?
Yeah, I love this chart, Jared, and I'm glad you bring it up. It's called the chart of truth. I think Ralph Hall may have coined that term, but a lot of people have looked at this chart over many years and drawn the downward channel. And what's interesting is we really are just at the point where that channel is starting to be broken. And the question is really, should we do the channel just like you've drawn it there, which is perfect, or should we really draw it a little bit from the higher highs? And then it would really be a change in trend as we've seen over the last couple of weeks. So, I actually am in the camp that this is not the end. I think that bad demographics, both here in the US and in Europe and in Japan, excessive debt, particularly government debt, and massive deficits are basically going to pin the central banks back in the corner. And while these short-term moves can be sharp and they can cause a lot of pain when the high-frequency traders get in there ahead of the big institutions, I believe that there's very few things that I see that are truly inflationary. We had a currency deval right after the lockdowns, where the Fed and other central banks around the world printed about 40% of all the currency that exists in the world. That's a crazy stat when you actually say it out loud, that 40% of all the dollars ever created in the history of our republic, which is 256 years, happened in the last 24 months. So that is a currency devaluation as opposed to a demand pull inflation. And I think if you take out oil prices, which are now reversing, and you take out used car prices, which are now reversing, those inflation numbers really do tend back toward that 2% number. And I think 6 months from now, we'll be looking back on this saying, yeah, it probably was much ado about nothing. But that's just my opinion.
We're going to circle around to that in a little bit. The headline is crypto, so we got to take that to task first here, or at least next. Where do you see where we are with crypto prices? I'm looking at Bitcoin right now. Maybe we can get a screenshot of that. Let me put a little bit. Let me finesse this time frame here. All right, so we dipped below 40,000. You don't have to give me your take on the technical short term, but I'm trying to figure out where you think we are in the cycle of adoption with Bitcoin, and where is it going from here?
Yeah, look, well, we're in crypto winter, and everybody hates when I say that, but we've been in crypto winter since the middle of last year. And what does that mean? Well, there's a 4-year cycle in Bitcoin in particular, and other cryptocurrencies, basically defined by the halving cycle. And in that 4-year cycle, we really do have 4 seasons. We have winter, spring, summer, and fall. Winter is too cold, summer is too hot. That tends to be times of a lot of volatility, and you tend to make all your money in spring and fall. So, we had the fall run up back at the end of 2020 into 2021. Winter started kind of the middle of 2022, and middle of 2021. And we had this interesting kind of relief rally in the fall into November, which I thought was a lot of people getting overly ebullient about where we were headed. People thought we could see 100K. They were looking at the stock to flow model. I just didn't think that was going to happen. And really, you can put a pin in it to the day of the release of the Bitcoin futures ETF. November 18th was the top, and we've been in a downtrend ever since. And I think the reason for that is anytime you have paper assets that can be created out of thin air, whether it's oil futures, gold futures, now Bitcoin futures, it really messes with the underlying commodity demand. And it allows the big banks to put downward pressure on prices. So I think that's exacerbating the winter that we've got here. So there is a lot of institutional buy-in, Jared, on the other hand, which would give you that support line that we've seen right around 30,000, which is why I don't think there's any danger of crashing through that. But I think it's going to be rocky for another 12 months or so.
Well, let me ask you, you just mentioned some of the volatility, but also in the market, there's a big focus on the regulatory structure here. And we have Gary Gensler, who very blockchain savvy. A lot of people thought he was just going to sign off on the Bitcoin ETF as soon as he came in. Of course, he postponed that. And now we only have Bitcoin futures ETFs, at least here in the US. If you're an accredited investor, you can access a Grayscale investment trust. That's something entirely different. Just wondering, what's your take on Gensler here? Because he's defied a lot of expectations. And it looks like we're not going to get a spot Bitcoin ETF until next year, at least. And that kind of, I guess it kind of folds into the conversation we're having about paper.
I would take the over, Jared. I would definitely take the over. Look, Gensler is a really smart guy. And to your point, he's really knowledgeable about digital assets and cryptographic security and blockchain technology. He taught a class at MIT, I think. So no question that he's a smart guy. But bottom line is he's a banker. And he comes from the banking world, and there's a lot of pressure from the banks to slow down this disruptive technology. And that's true of every disruptive innovation in history. The incumbents use regulation to slow down the pace of disruption. One of my favorite stories is, at the turn of the century when the horseless carriage was coming to be in favor, they passed a law, the horse and buggy companies and the buggy whip manufacturers passed a law in New York City where you had to have somebody walk in front of your horseless carriage with a red flag. That's where the term red flagging comes from, so that everybody would know that you were driving down the street, which made it really slow and really tedious and really expensive. So it took a while for horseless carriages to come to be the primary means of transportation.
They're going to do that with robo-taxis, by the way, I think.
Pardon?
I think they're going to do that with robo-taxis in the beginning, but just not to interrupt you.
No, I think that's exactly right. And any disruptive innovation that threatens an incumbent, the incumbent will lobby, which I always say is just a fancy term for corruption. They will lobby to get regulation passed to help them stay at least in control for some period of time. At the end of the day, innovation wins. And in fact, I talk about this all the time. Innovation is an asset class. It's the best asset class you can own over the long term. And my pinned tweet on Twitter is, you make the greatest wealth investing in innovation. And what that means is you invest in something that you believe in before others even understand. Let's take Bitcoin, for example. Bitcoin is a great long-term investment because the average person still has no concept of what it is, why it's important, what blockchain technology is, what a distributed ledger is, how proof of work works in terms of sustaining the ecosystem and validating the network. So all those things will eventually be invisible. Like I talk all the time. I don't know how my cell phone works. I don't know how you and I are talking in HD right now using TCP/IP.
The miracles of technology. Yes.
Yeah. Talking to this metal and glass box, but I don't need to know. It becomes invisible. I accept it. I buy my Apple product and I'm happy about it. So I think the same thing is going to happen here. But the difference is what the internet did to media and commerce, which was a lot of disruption. Remember, there was lots of regulation that tried to be passed, from net neutrality to all kinds of things to slow down that disruption. This is bigger. This is the disruption of financial services. Financial services have had an 800-year run since the 1300s when the Medicis really took over. And the Rothschilds in the 1600s and 1700s. And today we've got the big banking cabal around the world. And they would really rather not be disrupted. But a third ledger that we trust using technology as opposed to human beings at a banking institution is the superior technology. And it will eventually dominate, but it's going to take time.
And take its time, it seems it's going to be, because we had a conversation offline last week, Mark, and I just want to kind of go over some of the points I was making about DeFi and how in the US, it's proceeding at a much slower pace than it is around the world. You have users of crypto. You have people with crypto holdings that want to get paid interest on their holdings, just like in traditional finance. You have a brokerage account at Schwab or TD Ameritrade, Robinhood. It doesn't matter. You can get paid on your holdings there, but not so in crypto land, at least in the US. And Gary Gensler has gone so far as to block firms from doing that, fine them. But it seems as though there is a way towards that. You have to securitize your assets. You have to register them with the SEC. Suddenly you have underwriters. Who are those underwriters? JP Morgan, Goldman Sachs. Then you have a custodian. Who's your custodian? Probably going to be Bank of Mellon, New York, something like that. And suddenly you have decentralized finance looking a lot more like traditional finance. And my concern is that there seems to be a lag. And whenever there's a lag in terms of regulatory response, where it proceeds much slower somewhere, let's say the United States, than it does elsewhere. And I liken this to an historical example. When you had the collapse of the Bretton Woods system in 1970s, you had banks over in Europe that would take your dollars and give you an above market interest rate. So people would send their dollars over to Europe and they would get paid this above market interest rate. And then just kind of bring it all home. All of that changed. It culminated with the repeal of Glass-Steagall in 1999. We know how that went. But do you see the US really just falling behind the rest of the world in terms of adoption of decentralized finance?
Jared, it's a really, really great insight and important insight, in that if you look at history and, One of the great things about history is the farther back you look, the farther forward you can see. So said Winston Churchill. And I think if you do look back into economic history, particularly financial markets history, you see this evidence where if one jurisdiction is overly burdensome on the regulatory front, because we become more and more global over the past century, that capital will just flow into those other jurisdictions. So you gave the perfect example of the Eurodollar market where, geez, if I can't make a return on my money here, I'll just move it outside the borders of the US. And I think that same thing is going to happen in crypto is if the SEC, which had been, past tense, very measured, very deliberate, very consistent in ruling that Bitcoin was not a security, Ethereum was not a security, other things were securities. They gave a little bit of regulatory clarity. They put up some nice guardrails, and the progress was very positive. Lately, they've gone the other way and kind of said, well, we're not going to tell you when we're going to rule, and we're not going to rule favorably on innovation like the ETF. And maybe we'll even fine some of the people that had innovated. So I do think you're exactly right. Because we live in a global, borderless world, particularly in the metaverse and in a digital world, you can take that capital anywhere. So look what happened in China. China tried to ban Bitcoin mining. What happened? All those miners ended up in Kazakhstan and West Texas. 4 years before that, they tried to ban exchanges. So what happened to the Chinese exchanges? They ended up in South Korea and Japan. And so it's like squeezing the air in a balloon. It's just going to go someplace else in the balloon. I guess if you squeeze in too many places, you could pop the balloon, but that's not happening. Certain jurisdictions look at the opportunity to be more favorable and to attract that business, ultimately that tax base and those clients. So,
and where do you see those places right now? And should an average investor be looking to invest in companies that are in those spheres?
Yeah, I think it's great. Again, great question. So, you've seen some really great jurisdictions pop up around the world, places like Malta and Bermuda is making a big push in the digital asset space. Those are ones that many people have heard of, but you're also seeing places like Singapore in the Far East. And then interestingly, there are European jurisdictions that are arguably more favorable even than we're seeing in the US. So you look at the recent ruling on BlockFi, where the SEC fined BlockFi, and they now have to register their interest-bearing account as a security in the US. They don't have to do that in Europe. They don't have to do that in Latin America. They don't have to do it in Asia. So all those markets look quite interesting. And we're seeing, I won't call them imitator. Yeah, but I guess I could. I'll call them imitator companies in those jurisdictions that people can access, again, because you can go on screen into your computer and go anywhere in the world instantaneously. It's not like the old days where you had to get on a plane and fly to a different jurisdiction or go all the way back, postal service.
Yeah. Well, this is a great transition because I was going to ask you about the metaverse, and that's kind of what we're talking about now. Just this digital reality that kind of transcends our normal reality. It's real time. Everybody can interact. And you write about this. It's in its infancy. We know that, but we know that people like Facebook are interested in it enough to change the entire name of their company around it. So what should people be paying attention to here? Yeah,
I mean, the metaverse is a really interesting thing in the sense that what is it exactly? Some people think of it as a place like Decentraland. Facebook would like you to believe it's their app and they will become a metaverse company. We look at it a little bit differently and say, to me, it's that integration point where your digital life and your physical life start to overlap. Many of us would be probably frightened if we actually looked at our screen time counter on our mobile devices and it actually told us how much time we were spending digitally online. And one of the interesting things is, let's just take a simple idea of fashion. Think of all the money that has been spent over the years in couture fashion, and you wanted to have the latest and greatest fashion. And then we had social media where you could post pictures of yourself wearing latest fashion or trends. And we tried to get influencers to wear a certain thing or hold a certain bag. Well, now that's all being moved to not physical goods and physical fashion, but digital fashion. You have digital clothing or digital accessories for your digital persona online. And I think the thing about the metaverse that's so interesting is it's building on top of all of this previous history. So, here you got a slide that says, the term was coined by a fiction writer, Neil Stephenson in Snow Crash. Then we had a series of movies made about this idea of reality and digital reality kind of coming together, The Matrix. And then, Ready Player One showed us a dystopian view of, we're all in our trailers, kind of post-apocalyptic, but you can escape to this metaverse. And of course, Mark would like you to escape to his metaverse, which he reminds me of kind of the main character in Ready Player One. Not exactly my favorite guy. What I think is important on this next slide is this idea where it's where we work, transact, and socialize. It is that integration of our digital life and our physical life. Many of us are working from anywhere now. You and I are communicating digitally right now. We're going to store this digitally. We're going to allow people to access it digitally. It becomes part of that bigger metaverse. And I think next slide, I think is the one that talks about, the attributes of what the metaverse means. So this idea that it's persistent, right? That it's always on. You can come in and leave at any time, but that it's synchronous, that people from all parts of the world can interact in real time, interact together. You can interact independently, that it is accessible. There are no restrictions. It will scale. The thing that I think is really interesting and compelling is this idea that communities, we think of social networks and communities that we participate in, whether it's an alumni group or some friend group or Twitter group. Now we're going to have those communities turning to economies. And take a game like Axie Infinity, which is kind of a knockoff of Pokemon. You got this game Axie Infinity where the activity of that game is now counted in the GDP of the Philippines because there's so many participants in the game. Scope is a really important thing. It has to do with, again, everything in both our physical and digital world. One of the points that still has to be solved is this idea of interoperability, the idea that multiple blockchains can be interactive, that we can move into and out of different games or different media experiences and take things with us. I think that's going to be a challenge in some cases. The dream is you buy a gun in one game and you can use it in another. That'll be harder actually than it sounds. You can wear your skin, your clothes, but the actual games or the actual components of the game might be a little harder. And then this idea of a contribution economy or contributors or creators, this creator economy. All of this, I think, says that the future is going to be very, very bright in bringing digital assets, cryptocurrency, the digital ecosystem, all as one that we think of as the metaverse.
And I love your optimism, Mark. As we know, though, things can go wrong. And I'm not looking for your thoughts on any kind of dystopian, far out there future, but we know that when we have new technologies, they can be used for good and for bad. You put a bureaucracy in the mix and you have all kinds of new regulations. Just how do you think this sorts out, and what kind of headwinds should we try to avoid as a society as we gear up for the metaverse?
Again, Jared, such an important question, and there's all kinds of little things that we think of, but then don't think of kind of the unanticipated consequences, the unintended consequences. So let's just take currency. So I made the case earlier that gold has been money for 5,000 years, right? It's the only asset that exists in the absence of a liability. Everything else that we think of as money is actually not money, it's a currency. Gold is the only thing that has stored its value for 5,000 years. For 5,000 years, 1 ounce of gold has bought a fine person's suit, whether it was in Egyptian times, suit of armor, zoot suit, to Savile Row today. Now, what's interesting is there have been 775 paper currencies in the history of the world. 3/4 of them no longer exist. In my bag right there, I have a Roman solidus. Now, that was not a paper currency, but a coin. And it used to be the most powerful currency in the world. If you had a solidus, you were solid. That's where the word comes from. You were a citizen. And today it's a trinket, right? Bought it for $1 in Rome. And all currencies eventually fail because, exactly to your point, governments come in and destroy them because they consolidate power at the top. They steal the wealth from the masses through inflation and ultimately through currency devaluation and debauchement. And then the empire collapses, whether it's the Ottoman Empire, Roman Empire, British Empire. Every empire has fallen because of profligate spending. And gold for 5,000 years has been the perfect store of value. Now, gold has 2 defects. One, it's really heavy, right? And it's really hard to divide. Like if I had a bar of gold, it was really hard to carry it around. And if I wanted to give you half of it, I couldn't slam it on the table and break it. It's just really tough to divide. Bitcoin solved the scarcity problem. They created a truly scarce asset in the digital world where we go from an analog good, a bar of gold, to an electronic good like shares of GLD, to a digital good, a digitally scarce record of your ownership of a Bitcoin and the Bitcoin blockchain. And so that is infinitely divisible down to 8 decimal points. And it's light. All the Bitcoin in the world fits right here on my mobile phone. I don't have all the Bitcoin in the world. In fact, don't try to send me because I don't keep any on my phone. Keep it in cold storage. But the key is that it's light. It's transparent. It's also portable and transportable. And so I think it has all the benefits. And so when you think about money, all right, that is what I think will be money. But the dystopian side is central bank digital currencies. People say, oh, well, the governments will just create their own cryptocurrencies. No, they will create digital currencies. A digital currency is different than a cryptocurrency. A cryptocurrency is decentralized, meaning there is no one in power. There is code that tells us exactly how many Bitcoin will be created for the next 140 years. There's no debating. There's no bunch of pale, stale, white male guys getting in a room and deciding where interest rates are going to go. We know the monetary policy of Bitcoin forever. That is untrue in the traditional world. But what's likely to happen is the renminbi, the euro, the yen, the dollar will eventually be these digital assets. They'll be centralized, which has the defect of having control. But here's the worst part. Imagine a programmable money. And if people haven't seen the video of this guy, Augustin, I can't remember his last name, he's the head of the BIS. And he's this gigantic person. He looks right out of the cartoon Multiverse and Spider-Man like Kingpin. And he talks about how, well, yes, of course, we should control how you spend your money. So imagine this terrible world. You get paid on Friday, you go out and have a couple of drinks, you get home, you drunk tweet some bad stuff about the president, you wake up the next day, and he looks just like Kingpin. And you wake up the next morning and your money is only worth 80 cents on the dollar. Or worse, right? Some company pays the government extra lobbying so that you can only spend your money on their stores instead of the store that you want to. So there are elements of the positives of this technology that could be used against us, so to speak.
Are you concerned in the U.S. that we might take the same tack as China, which is they've already rolled out their digital currency and fully trackable, not really that transparent? Do you see that coming to the U.S.?
Yeah, look, digital renminbi is clearly being used for surveillance. It's being used for social credit scoring. Again, imagine you got paid on Friday and you thought you had $100 and you jaywalked that day. Now you got $95. and you got up and you complained on Twitter about getting a ticket for jaywalking. Now you get $90. It's just a bad downward spiral. And I do worry that same type of control will be coveted by government here in the US. I think we do have a little more balance across Congress, right? We theoretically have three divisions of the government to prevent that. And I think we've seen some good evidence where those checks and balances do work. Take the abolition of the mask mandate. I thought that was a good example of judiciary and executive kind of working together, I guess, at cross purposes, but ultimately working to get a good outcome. So I like the fact that, or I give us better chances than some of the more authoritarian states in getting a little better solution. But look, absolute power corrupts absolutely. So I do still fear the surveillance part and the control part of central bank digital currencies.
All right. And let's come back to the world of investing now. We have Bitcoin, it looks like, hovering under 40,000 right now, Ethereum under 3,000. If you're new to the game of crypto, where do you even begin? And is it okay for investors who are just kind of new to the game to just get a little skin in, but how much is too much for the average investor?
Yeah, look, I mean, the title of the presentation that we're kind of taking bits and pieces of is called #GetOffZero. And if you, again, go to my Twitter stream or type in the search function for #GetOffZero, you'll see lots of stuff about this idea that zero exposure is the wrong number. And, it partly goes back to this digital divide on the right-hand side, that cartoon. If you ask anyone over 35, who's your broker? I don't know, UBS, Merrill Lynch, why? How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Oh, are you kidding me? It's a Ponzi scheme. Warren Buffett says it's rat poison squared. Zero, of course, zero. How often do you use DeFi? What's DeFi? Ask the couple on the left, right? Who's your broker? What's a broker? You mean my Robinhood account? I got a Robinhood account. Okay. How much gold do you have? Boomer rocks? Are you kidding me? Zero. Why would I have any of that shift stuff? Gross. How much Bitcoin do you have? I don't really want to talk about it. Why not? Because it's a really high percentage of my net worth. I'm kind of embarrassed. How often do you use DeFi? Every single day. So that digital divide has already happened. Young people have crossed the chasm and do own digital assets. The average old guy like me, the average boomer doesn't. And you need to get off zero. And whether it's 1%, 3%, 5%, 10%, it doesn't matter to me, but you got to get off zero. I say you should start with the base, right? Bitcoin, Avalanche, Solana, Ethereum. And why do I say that? Well, Bitcoin to me is the king. It's like the TCP/IP, which is the base layer of the internet of value. And the same way the internet started with 80 different protocols way back in the 70s and 80s. By 1991, we were down to 5. We had TCP/IP that basically runs the internet. We have SMTP, so we can transfer emails. We have FTP to transfer files. We have HTTP to power websites, and we have www.
I think there was Gopher too at that point, but that was a predecessor.
No, there were a handful of protocols, and today we pretty much use 5. And there are a couple others, but bottom line, there weren't that many from the 80 originally, 80. And there are thousands of wannabe protocols in the metaverse and in the blockchain era. And I think we're going to come down to a similar number. And I do think Bitcoin is like TCP/IP. It is the base layer on which things will be built. I think Ethereum is kind of like www. It allows you to build applications on top. Filecoin kind of does what FTP did. And then you've got a debate, is it going to be Cosmos? Is it going to be Solana? Is it going to be Avalanche? Is it going to be Polkadot? Maybe we'll have 3 or 4 instead of just 2. But I think we're going to have a relatively small number of protocols that will power this going forward. So for the average investor to start, I would definitely own Bitcoin. I would definitely own Ethereum. We like Avalanche a lot. Actually, full disclosure, we're about to announce a big investment in Avalanche with our venture capital fund. I do like Solana. Again, full disclosure, we made a lot of money on Solana. We invested a few years ago. and are up many, many, many fold on that investment. But there are other good protocols as well. But for the average investor, have a Coinbase account, have a Gemini account. Again, full disclosure, we're investors in both of those companies in the private markets, and use that centralized finance network, right? It's not full DeFi. So dip your toe in, go with a name you trust, like a Coinbase or a Gemini, and then eventually dabble in DeFi. Once you try DeFi, once you have the first peer-to-peer experience with no middle person
going back, right?
And no fees, there's no going back. And ultimately, we will go there. But there will be this period of time, I think, as we go from TradFi, traditional finance, to DeFi, decentralized finance, there will be a whole swath of people. I say my dad, 84 years old, loves his Bitcoin, never going to hold his own keys, never going to have a ledger. He likes going to his Coinbase account. That's perfectly great. I like the ability to have some of my assets at a place like Gemini. They issued a credit card so I can get paid rewards in Bitcoin. Really exciting stuff rather than airline miles where I try to remember. When was the last time you got to get a free flight for 20,000 miles? They inflate or devalue your rewards, basically stealing your wealth. It's crazy.
You know, I love how we're talking about Web3 and Web 1.0 terms. And just thinking about some of the earlier stuff you were talking about, disruption, and I think it kind of relates to what we were just talking about too. You know, you're talking about going to Coinbase for crypto purchases, but you take a look at Coinbase stock. I'm going to pull up a chart right here. Hopefully we can share that. It's been rather depressed. I'm wondering if you like any crypto plays in specific stocks.
No, look, I'm a long-term holder of Coinbase. You know, we were early investors in the private markets. We did sell a little bit to provide our investors with some liquidity, but we still own a meaningful percentage of our shares and really like it. You know, when they announce their NFT marketplace, which is coming, I think it's going to be really positive. And this is the dominant market share leader in the space. But right now, anything to do with innovation, Jared, is just getting pounded. And this is a big holding of ARK. And, you know, ARK has been getting liquidated like crazy. Look, when the liquidity of markets is expanding, what happens? Okay. Growth and innovation come in favor, and then they go up a lot, and they go up really, really fast. When there's a threat of changing that liquidity, or in fact, reversing that liquidity, what goes down? A lot, growth and highly valued assets. So one of the things right now is innovation as an asset class has gotten pummeled so hard in the last 12 months. I would start to pick through that wreckage and look for some long-term winners. Some of the companies that came out as SPAC mergers, some of the companies that were the darlings of the lockdowns. You know, one of the ones we're using right now to talk to one another has gone down a lot. But the long term for these tech companies, I think, is very bright. But the short term pressure on their stock price has been pretty intensive.
And it has been. How much of that do you think is a function of the current environment? And just based on what you said, you know, you're talking about liquidity. We had this incredible, I think you mentioned 40% of all dollars have been created since the pandemic, something like that. So if it's all liquidity based, and we have the central banks around the world in a global tightening cycle, we have the Fed threatening quantitative tightening, which I don't think they have their heads wrapped around. This seems like a kind of a dangerous environment for these high-flying growth stocks. Even if you want to own them long-term, any kind of strategy you can advise investors, and then any kind of time frame, when do you expect these investments to start producing returns and just becoming stable stocks?
If you owned them and you've round tripped, sit tight.
A lot of people have
bought them. If you bought them at the peak and you're down a lot, that's more painful. Here's what I believe on that, Jared, is that I believe, and it's just my own personal opinion, that the number of rate hikes this year is going to be a tiny fraction of what everybody thinks. I think the global central banks are going to reverse course. probably pretty quickly. It's a midterm election year. I think the likelihood of the Fed raising rates dramatically into midterms, I think, is very, very low. We've already seen oil prices roll over. That was necessary for, again, the incumbents to have any chance at the midterms this year. Look, there's an inverse relationship between presidential popularity and oil prices, or gasoline prices, which are linked to oil prices. That has started to reverse here, and I think there could be meaningful pressure there. But interest rates, mortgage rates, all of those things are tied to happiness. And if inflation is still in the high single digits, again, I think it will be in the low single digits by the end of this year, as those things like oil prices and used car prices prove transitory. But in the end, I just think we're going to get the Powell pivot. I think we're going to get a dramatic shift. I think by the end of the year, we'll be expanding the Fed balance sheet, not contracting it. And that could be very, very good for these stocks. So I wouldn't buy all today. I'd buy a little today. I'd buy a little next week and next month and the month after. And I was talking to a friend about this actually, and they said that, usually sell in May and go away and don't come back till Labor Day is pretty good advice. And that's probably not bad advice. If I just kind of got in an RV with my son and wife, and we just spent the next 3 months touring the country, we'd probably be a lot saner. We'd be a lot happier and maybe a lot wealthier because we just wouldn't pay attention to the markets. But rather than come back after Labor Day, I might come back mid-August and really start accumulating, because I think right before midterms,
that's Jackson Hole, by the way. That's Jackson Hole. Interesting announcements could always come from
no, Jackson Hole, exactly. In fact, maybe I'll do that. Maybe I'll get in the RV, I'll drive out to Wyoming, and I'll park outside, and I'll heckle Powell and say, all right, come on, where's the pivot?
Oh, wait. Well, please don't heckle Yahoo Finance's Brian Chung, who also goes out there. But I get your point here, Mark. We have a few minutes left. I'll give you the floor here. Just anything on your mind with respect to some of the themes we've been talking about, what investors should kind of wrap their heads around, because as we've been saying, it's been a painful year for most investors.
Yeah, look, I think you framed the conversation really well. And I would just reiterate a couple of things we've talked about. So one, because of the difficulty of the environment we've been in, it's really been about discipline. Discipline to rebalance, discipline to focus on fundamentals. As painful as it was to kind of step away from the super high valued, FANG man stocks that were the darlings up until November of last year. As soon as you began to see the shift in sentiment at the central bank level, it was time to rebalance away from FANG man into things like energy and natural resources and other assets that have actually done very well. The value versus growth shift has been robust. And I think for the average investor at this point, right, saying, okay, no matter what we did up to this point, my guess is people are really down on bonds, and they're really down on long bonds in particular, because they think they've lost their ability to be a safe haven asset. I might rebalance a little bit. I might pick up a few of those. I probably would think about what's likely to happen around the oil and gas trade. It's been a really, really good trade for the past 18 months. Probably time to take some profits there. I would think that even though the FANG man stocks are down a lot, their valuations are still really, really high. So I probably would continue to rebalance away from the super overweight in growth. And for those who just have no exposure to crypto, I think now's never been a better time to begin that process of averaging in. And it's funny, I did a show with somebody a number of years ago, and kind of intra show, the price of Bitcoin went from 10,000 down to 8,000. They're like, what should we do? I'm like, you should buy it. And they're like, what do you mean? It just went down. I'm like, yeah, you should buy it. And they said, well, you would say that if it went to 5,000. I'm like, yeah. And I'd say it even louder, and you shouldn't buy it all today. You should buy some today and some tomorrow and some next week and some the week after. And you should accumulate a position in what I believe are the assets of the future. Digital assets are the assets of the future. And all of the infrastructure plays on those digital assets, I think, need to be part of your portfolio as well. So,
which are, and could you go over, we do have a couple more minutes. So infrastructure, what kind of
infrastructure would be, the exchanges. So Coinbase is an example of that, but exchanges, and I think there will be other exchanges that come public in the next year or so. I know Gemini is a company that long-term would like to be public, and a couple other firms like that. So I think you'll see increasing numbers of digital asset companies go public. You've got the mining companies that secure the networks. Some of them have fallen a lot and are starting to look like values. The challenge was they got really overpriced a while ago, but they're starting to fall back into reasonable territory. And those are just basically like data centers. Data centers have been great investments for 20 years. Basically, you're selling your computing power to AWS and Microsoft. With Bitcoin mining, you're selling to an algorithm. You don't even have to go find clients. So I think, slowly buying those types of things. And then there are some, companies like Overstock and others that are, again, trying to put in the infrastructure for market making, settlements, and all the things that we do in traditional finance that will eventually happen in decentralized finance.
And is there any room, well, we've been talking a lot about growth. Is there room for value in an investor's portfolio? If so, what kind of names would you be looking at, taking into consideration? You think the move in energy is over, but value as, I guess, a style. Is there room for it?
I do like value. And I think, there are certainly, you've got some companies up here in the payments area, like Square and PayPal, that are interesting long-term plays. And they actually have ties into crypto as well. I think, payments infrastructure companies globally have really taken it on the chin, along with financial services. So there's probably some value in those areas. We see value in industrials, just the companies that make stuff. Supply chain problems have disrupted their businesses. Now, I think the short term could be painful because it looks like the supply chain problems might get worse. We had a conversation this morning with our China team over in Shanghai, and it's bad. I mean, these lockdowns are really, really bad. And so it's going to take a while to unwind the lockdowns and get back to a more normalized trade and transportation infrastructure in the ports around China. So I do think there's probably some bouncing along the bottom here before we have a nice recovery in those real industrial companies. And then finally, in a world where I believe that we will see a Powell pivot and we will see a reversion back toward more money printing later in the year, that would pave the way for accumulating more stuff, right? The kids' game, rock, paper, scissors, paper beats rock. In the real world, rock beats paper. We like real assets better than paper assets.
All right, we're going to have to leave it there. That was a great discussion. Really glad that you could join us on our first episode ever of Yahoo Finance Uncut. Mark Yusko, CEO and CIO of Morgan Creek Capital Management. Stay tuned because we have more programming ahead.